Rubicon M&A Insurance Services is now a proud member of the Liberty Company network of insurance brokers. So it is a thrill to be here and to share with you something that I would tell you as an experienced insurance person. Insurance has been an unfortunate necessity in a lot of cases, but we're adding value and so forth. I can tell you this product, Reps and Warranties, has had such a profound effect on the parties in mergers and acquisitions deals that it has literally catapulted the number and speed of deals happening successfully, unlike any other factor that's out there. And I'm very, very proud of the way our industry has come in and really accelerated some great things. To give you a little bit of context here, there are an average, depending on who you talk to, okay, pre-pandemic of about 1,500 M&A transactions per quarter. Okay, one of the insurance carriers, Euclid Transactional, which is one of the more reputable firms out there, and they're pretty active. In 2021, they had 9,000 submissions for rep and warranty. So that was 9,000 deals they were asked to look at. The number of policies they actually placed, a few years ago, they were happy that they placed 100 policies in a year. In 2021, they did 1,270 policies. They had 157 of those were bound in December alone. So that tells you that this is a product that has a great amount of traction, and there's a lot out there. And I'll tell you, most people who are not involved in mergers and acquisitions have barely even heard about this product. So I'm really pleased to share this with you. But before we get into Reps and Warranties, let me just give you a little bit about myself. Again, the name is Patrick Stroth. I'm a native San Franciscan, and if you're born and raised in San Francisco, you're just obligated to share that news with everybody. So we're very proud of that. About 20 years ago, we moved from native San Francisco down for better weather, better parking, and better home prices. And we moved down to Silicon Valley. What is important about Silicon Valley is not that it's the tech hub, but it's the perspective that people have here. Okay, there's a business entrepreneur consultant named Dan Sullivan. And when he talks to entrepreneurs, he says, when you're forming your company, begin with the end in mind. Well, in Silicon Valley, that's what they do here. They are planning, when they start a company, they're thinking one thing, exit. Okay, how are you going to build this thing and get the heck out of it and cash in? Okay, 20 years ago during the dot-com era, it was via IPO. Now you got a couple of folks that are engineers at Facebook or Google. They want to start up their own firm. Within 5-6 years, they're going to cash out and get sold probably to Apple or Google or Netflix for $40-50 million. They're looking for exits. And that's what happens. The deal of setting up a company for a legacy or unicorn, that's not what happens now. They're looking to exit. Now, I've been involved in insurance for 30 years, everything from personalized to special event, all the way up through Reps and Warranties. And I can tell you, this is the most fun product I've ever had in my 30 years. And in my day job, in addition to M&A, we do a lot of directors and officers liability. This is really good. And it comes back to this epiphany I had in 2016. I had a policyholder that he had 3 or 4 companies. He was bundling them together to sell to a healthcare conglomerate, about $50 million transaction. And the doctor comes to me, he owns this thing, and he says, Patrick, I'm going to get this. We need to get this closed. And I said, great. Well, Doc, I hate to be personal. What are you going to do with the money? Well, I'm going to go build settlements back in the old country. I'm going back to the old country because my community is building settlements. And I want to do that. Oh, where's that? Israel. Whatever they were building in 2015, 2016, that's what he was going to do. So he's committed to that. When the buyer found out that he was going to be leaving the country right after the close, they said, look, we hate to be adversarial, but we got to hold back half the money for at least 3 years. Because if there's a breach of the seller reps and there's a financial loss, once you leave the country, the money's gone. And we can never collect it. So we're terribly sorry, but this is what we have to do. So the client comes back, and if you've been in insurance, okay, tell me if you haven't heard this from your client. I got to get this policy. I got to get this deal. Price is no object. And I said, well, there's a way we can insure this, but I mean, the price is prohibitive. And he's like, price is no object. And when he said it, as a lot of clients do, in their heart and soul, they really believe it. That, give me the price. I'm willing to pay it, whatever it is. Until you tell them what the price is. Then it becomes a really big object. Then they decide, this solution, it's a problem, but I can live with the problem. So no need. And I was thinking that was going to be the case because in 2015, 2014, Reps and Warranties, I had heard about it, but it was very, very expensive. I was happy to find out for less than $500,000, we were able to get a policy lined up for this client so that he was able to exit. And he didn't have to keep $25 million in an escrow account for 3 years. He only had to keep $1 million in an escrow account. That was the deductible of that policy at the time. Okay, so we were able to go ahead with this product and have this client exit with $49 million more than he otherwise would have. And when I saw that impact and how profound that was for this individual, who I really respected, I thought, this is how we're going to pivot our business. And so what happens, and just, from my perspective, we'll get a rep and warranty in just a second, but I got to tell you, this is the mission that I have here. I consider mergers and acquisitions to be the most exciting event in all of business. Some people think it's an IPO. I think an IPO is very similar to being picked in the first round of the NFL draft. It's very exciting, but you really haven't proven anything. Your work just began. With mergers and acquisitions, there's nothing else out there that will create a life-changing, if not generational, positive impact for owners and founders and their families. And if we can make those life-changing events happen faster, safer, smoother, less hassle, who wouldn't want to be part of that program? And so that's why I'm full in on this, and I hope you join me too in this as we go forward. And we'll give you a lot of perspective on this. We can get into nuts and bolts at a later time, but this is to set the stage for you. So what are reps and warranties? It's an insurance policy that covers the reps and warranties, which are the disclosures that sellers make to a buyer when they are selling their company. What their financial condition is, the number of clients they have. If you sold to your insurance agency, what markets do I have? How many clients? Where are renewals? Things like that. If it's a manufacturer, here's our equipment, here's our inventory. They make all these disclosures. Now the buyer doesn't take that on faith from the seller. Okay, they're going to go. It's just like if you were to buy a house. They may say the house has a great roof and the plumbing all works. You're still going to bring in an inspector to take a look at the house. Okay, that's what buyers do. It's called due diligence, and it can take quite a bit of time, but that's where they check all the numbers and everything. Okay, what the insurance company what usually happens without an insurance policy is the buyer and the seller go ahead and they agree. The seller has the reps. The buyer goes and vets them to the extent they can, and they say, okay, in the event that's, we will purchase price is X. Okay. In the event of a claim, we want to be able to have the right to get some of our money back if we didn't get what we expected. And so the remedy for the buyer is they're going to claw back money from the seller. Now that creates tension because obviously the seller is going to sit there and say, I told you what I know. And the buyer is like, well, that's okay, but we still want this money back guarantee. And absent anything else, then you're going to have that natural tension between the two. Enter reps and warranties. It's a third party because you've got the buyer on one side, you got the seller on the other side. You have this third party that comes in and they literally look at the disclosures, the reps and warranties that the seller made. They underwrite and look at what the buyer's due diligence process was. How did you double check it? To what extent? And then they say, okay, I'll tell you what, for a couple bucks, we will take the risk on. So buyer, instead of coming after the seller, if there's a financial loss you suffer that stems from a breach of the seller reps, come to us, we will write you a check. It's great because buyer knows they're guaranteed that they're going to get their money. They don't have to go out and sue the seller or pursue them overseas as they were afraid of with my client. So they get peace of mind that they're going to get collected. Okay. Seller, they get a clean exit. They sign the papers and then they can walk away. And that's just the peace of mind that they want to have. Now, I'm more of a visual guy. So let's just show you what it looks like with and without rep and warranty. So this is admittedly a very small deal. Okay. This is going to be your, I'll talk about the average deal size, but just to use round numbers, will give you an idea on what these things look like. In a standard deal, let's say there's a $50 million transaction price. Okay. So buyer's going to give the seller $50 million, seller gives them the keys to the company. Okay. They will put in a money back guarantee where the buyer says to the seller and the seller agrees, okay, here's what happens. If what you tell me isn't true and I suffer financially, I can claw back up to $10 million from that $50 million. And what we do, which is standard in M&A, is they'll take a portion, usually half of that indemnity cap, and they'll put that in an escrow account. And they'll just say, look, that's just a bucket of money that we have that in the event there's a breach, we can readily, immediately access it, and then we can mitigate any damages that are out there. Okay, so the seller's got to swallow the fact that, you know what, at the close of escrow, even though they sold their company for $50 million, they're only getting $45 million at closing. Within 12 to 18 months, provided nothing happens, they'll get that other $5 million. So that's kind of what they hope for. Now let's take a look at it when we put an insurance policy. So what we do here is we're going to take a $10 million policy that matches the maximum amount. If the buyer wants more protection, good, they can raise this indemnity cap. We just get a bigger policy, no problem. So you have that set in. The policies carry what we call a 1% deductible. Okay, so rep and warranty, if on a $50 million deal, you're gonna have a $500,000 deductible before the rep and warranty policy pays. But because they attach right above 500,000, why is there the need to carry $5 million in an escrow account? You don't need that anymore. Bottom line, the seller gets, instead of 45 million, they get 49.5 million. That's 4.5 million more cash at closing. What's even more significant, not only do they get this extra cash at closing, which time value of money, how'd you like to have an extra $4.5 million in cash that you can invest over the next 12 months, okay, instead of having it tied up in an escrow. Not only that, but your maximum downside, if you're the seller, goes from $10 million if Chernobyl hits to 500,000. So you've gone from 20% to a 1% risk. Okay. You wonder why sellers are all insisting on this right now? It's because of that, the transfer of risk. Oh, by the way, so the cost on this one, that's less than 1% of the transaction value. Okay. So if this is structured right, I will tell you, if the buyer says to the seller, and this has happened in the past, it's happening less. But what happens is the buyer says, I'll tell you what, we're either going to do this without insurance, or if you, seller, pay for this insurance, we'll go get it. And then we're going to give you this. Okay. I will tell you, 99 times out of 100, the seller will gladly go ahead and secure this. So that when we put it out like this, it's like you can see why a lot of attorneys will look at us and say, this is a no-brainer. Why not? Now with these policies, it almost sounds too good to be true. So let's talk about what's covered and what's not covered on these policies generally. Okay. What's covered are general and fundamental reps. These are disclosures. They're just two different types. Fundamental are the more core disclosures where the seller is acknowledging that they in fact own the company that they're selling. If there are buildings, that they have title on the buildings, things like real big formal fundamental reps. General reps are going to be just the day-to-day disclosures about your company, your inventory, your annual sales, your financials, things like that. There are two categories. You don't have to worry about them too much, because here's the thing: the purpose of rep and warranty is to cover all of them. So they will all be included. We'll explain a little bit more. The other thing that's really nice about reps and warranties is the sole four corners of the policy is intended to address what is disclosed on a purchase and sale agreement. That's it. So unlike directors and officers and general liability, where they have very broad scopes of coverage and everything, and there are always disputes, this is finite. And that makes it a lot easier to handle when claims come in. We'll talk about claims. Okay, well, as we all know in insurance, okay, well, who cares what's covered? What's not covered? Because that's the thing we have to worry about. Okay, well, these are standard across the board with rep and warranty policies. Known circumstances, which is no different from any other insurance policy. If you got damage to your property or whatever, you're not going to buy a policy. You have to warrant against it. So in mergers and acquisitions, if the buyer uncovers some errors or some red flags that the seller messed up on, and they find out before purchase, though anything that you discover is not covered. Net operating losses is a standard thing where it's issues on intentional expenses for tax purposes and so forth. There may be tax benefits. These are tax credits, other loopholes that are outlined in the policies that may not be there. However, tax liability can be covered. So if you warrant that we paid our sales tax, or we're a manufacturer or a consumer products company, and we sell in 30 states, and we are consistent with the state income tax on all those 30 states and sales tax, we've done all that. If there's a breach of those tax liabilities, rep and warranty policy can cover. What's more common, particularly any of you out here in California, wage and hour claims are not going to be covered. That is across the board excluded. The real problem here in the tech sector is the dealing with independent contractors and employees. So that happens a lot. Rep and warranty policies are designed to cover the deal at closing. Okay, if there are future benefits, milestones, earnouts down the road, I mentioned we had the $50 million deal there. They said, well, we'll give you 50 million at closing, but if you hit these milestones, we'll give you another $10 million. You can't insure those forward-looking things or those milestones, so it's only that. Within some contracts, they have what's called a 10b5 rep. Those are just what we call catch-all. So you'll have your disclosures on your building, your business, your operations, HR, things like that. And then there's a final one that just says, in addition to all that, we still don't know about anything. Okay, that's being phased out in a lot of contracts, largely because rep and warranty policies don't cover it. And then there are other exposures that could be covered elsewhere. So you've got environmental issues. If you own a building and you are selling that building or manufacturing plant, there are environmental issues that won't be covered necessarily on rep and warranty. The reason why they do that is the reason why a lot of policies have exclusions, because you know what? That exposure is better addressed elsewhere. So you've got major tax issues could be out there. Environmental, as I mentioned here, cyber is another very big one that the carriers, rep and warranty markets are looking for other insurance that's more appropriate to handle. So I mean, that's pretty straightforward on how it is. And again, you're looking at the four corners of the purchase and sale agreement. So it's a very finite risk, and that's helpful because then everybody knows what they're getting. Two of the most common questions I get is two of the three. Okay, what's it cost and who pays? Well, the nice thing is, okay, rep and warranty policies are priced based on how much insurance you purchase. So it does not matter. The price for a $50 million deal will be the same as a $100 million deal will be the same as a $500 million deal. Okay, if you buy a policy, it's based on the limit. So it's essentially $25,000 to $35,000 per $1 million in coverage. Okay, so I mean, it's pretty straightforward. We'll talk about the demand, the trends going forward, but it's skewing larger to the higher end of the scale. Now, this is subject to a minimum premium between $125,000 to $175,000. That depends on the carrier. So we get a lot of deals or questions come in saying, I only need $2 or $3 million. And it's like, your minimum premium is going to be, this. Well, you can get $5 million for that. Why don't we just get the 5? So we have that happening. Now, I mentioned that the underwriters underwrite the diligence that the buyer performs. Well, the underwriters don't do that themselves. The underwriters go ahead and they hire outside attorneys to review the diligence reports that the buyer's buy team put together. I mean, that's the big thing with rep and warranty. If you're buying a company, then they have 100, restaurant locations. Did you go to every single restaurant? Did you inspect every single restaurant? Sometimes they can't do that. Okay. Well, but if they looked at the top 30, okay, well, the underwriters need an outside party to help them go through that. So there is a fee that's charged up front. A common question I'll get is, well, okay, we get a submission coming in, they want to get a quote, we get the quote, and all of a sudden they say, well, we have to pay this underwriting fee. Is there ever a case where you're going to deny the risk, but we're out the underwriting fee? Doesn't happen. So, and we'll get into the process in just a minute. So when you think of cost, think about the underwriting fee in addition to the premium. Smaller policies, like I said, can come in at or under $200,000. And these are deals, transaction value, maybe $30, $40 million, and you only need a $5 million policy, something like that. And that includes the underwriting fee. So on smaller deals, this is a no-brainer, provided that, the risk can qualify. Again, who pays? The policy is in the name of the buyer. So the buyer is the policyholder. However, the benefits are also to the seller because they don't have the big escrow and they get the clean exit. So it's very often that the two sides will agree as they're negotiating the deal to go ahead and just split the cost 50-50. But I have seen if a buyer is smart and they offer that deal like I showed in that first slide where here's with insurance and here's without insurance, it's your call. This can be free to the buyer. So, I mean, when you get those benefits for a buyer, it becomes very, very simple. So what's the process for doing this? Well, there is no application for reps and warranties. Some carriers had put out questionnaires in the early days, but they don't do that. Essentially, what underwriters are going to need is they're going to need the financial statements from the target. They prefer audited statements. If it's not possible, then whatever financials are available. The CIM is what's called a confidential information memorandum. So it's kind of a like a marketing piece that sellers will, and their investment banker, their representatives will give out to buyers to say, here's a portfolio of our company, here's all the good things, and here's why we think it's special and why it's a good fit for you. It's a great narrative that is prepared on these deals. And then they also want the draft purchase and sale agreement. The purchase and sale agreement does get finalized till the very end, but the sooner the underwriters can get a look at that, they get a look at what the reps are that are going to be outlined. Okay, when we submit these to an underwriter, we get within 2 to now probably maybe 3 days out after we do this, we get what's called their quote, non-binding indication letter. And they will go ahead and they will say, based on this size and this transaction value, we can give you, this limit for this premium subject to this retention. And then they'll list the reps that they pulled from the draft PSA. And they will, what's nice is up front, they're going to say, here are some areas of concern, provided you have some diligence here, we're going to have no problems. Here's some other areas where, we found some other things that, we're going to, they'll at least give you the red flags in advance. So you'll know, hey, if there's a real problem with this transaction, and they really want this one rep covered, we're going to know up front whether or not they're static. So it's good. So at this point, there's no cost involved. Okay. This is, provided absolutely no cost to the client. Okay. When they decide to move forward, let's say we get the quote, the NBILs in, and we pick a carrier and everything. This is where the underwriting fee gets paid. Nothing happens. The underwriters don't do anything until they receive the underwriting fee, which goes directly from the client to the underwriters, and then they move forward. They then access the records in the that the buyer has collected from the seller in a virtual data room. In the old days, 10, 15 years ago, I mean, they were literally having to go to offices and go through bankers' boxes of documents to do this diligence. And so that's why this stuff really has accelerated thanks to technology. So once that underwriting fee is paid, within 4 to 5 days, we're going to have everything we need to put a policy together. Now, the underwriters will schedule a call once they finish their diligence. They'll have a whole bunch of questions. They will want to talk to the buy team. They will usually have a list of questions, and it could be as many as 100 to 150 questions on various elements of the risk of the business and so forth, just to make sure that they're covering bases. A lot of it is check the box. Did you do this? Yes. Did you do this? No. Why didn't you do this? It wasn't applicable. Why wasn't it applicable? They answer it and they move on. So this goes, once this call is completed, underwriters have everything they need to go ahead and issue a policy. So what they do is they draft up the policy, they get it set up, and then they wait until closing. And what usually happens is if we have this underwriting call more than 4 or 5 days before closing, which happens a lot, they're going to have what's called a bring down call. So let's say you had the underwriting call on Friday, you close the following Wednesday, they're going to want to call the buyer on Wednesday and just to make sure before you sign, you don't know of anything. Everything we talked about, there's no change. No, there's no change. Okay, ready? Policy is ready. Policy doesn't take effect unless the deal closes. And I can tell you, there is a lot of hurry up and wait with mergers and acquisitions where they're just rush, and then all of a sudden somebody forgot a document, somewhere. And so that can't happen a lot. So there are a lot of times the policy, we don't issue it in advance. We wait until we know the deal is closed. We have a draft document, but a lot of times they'll say, well, the bank, want to hold off for 2 days for a wire or whatever. Let's delay it 2 days. Well, now we have to change the effective dates of the policy and all that stuff. The policy takes effect at closing. The premium is paid at closing. It is fully earned. So there is no issue on cancellation minimum premium. It's paid in full, done. So that's been the environment for reps and warranties. And so I just want to give you an update, in the wake of the huge demand and in the last couple of years, I mean, what's new about rep and warranty today? Where are you guys going to have an edge when you're talking to people about this product, even though some of them have maybe heard about it, but they probably have heard some of the old stuff. So just to keep you up to date on what's happening, okay, this is the most popular insurance product in mergers and acquisitions, okay? We had the pandemic, so mergers and acquisitions transactions slowed down for a little while, didn't stop, but we're back up at pre-pandemic levels. And with mergers and acquisitions, if you get around it, here's the beautiful thing about this, okay? There are a lot of prospective clients out there, okay? First of all, 4 out of 5 private equity firms are using rep and warranty right now. there are over 5,000 private equity firms out there. Each one is having at least one acquisition or sale a year, and many have a lot more than that. So there are a lot of organizations out there. One thing about rep and warranty with regard to private equity, just at their core, they are very resistant to spending money, on things like insurance. If they can transfer the liability to somebody else, if they get somebody else to get coverage and name them as additional insured and all that, whatever they can do to avoid getting a policy, they do. Except when it comes to rep and warranty, they are the most ardent followers of that. I'll explain that in a little bit. SPACs, if you've heard about those, there are 400 plus of those. And what SPAC stands for, if you don't know, is Special Purpose Acquisition Company. Okay, they are acquisition companies. Well, this is the tool for acquisition. And there are over 400 of these SPACs that are looking for targets, and they've got a limited amount of time in which to go ahead, identify one, and get it. We also are going to see a lot more M&A opportunities out there, just because there are a lot of companies, and this happens if you're selling your house and all of a sudden there's a down market, you take your house off the market. When the pandemic hit, there were a lot of companies that took their entrepreneurs and owners, took their companies off the market because their attitude is, hey, you know what? We can get a better price later. Let's wait. I mentioned that you've got all these placements. The rate right now is getting closer to 3.5%, could go higher because the premium rates are increasing because demand is so high. It's no other factor than that. Okay. We are seeing buyers, not only more buyers are buying more policies, they're buying bigger policies. Okay. There are now some policies where there's now an excess rep and warranty policy. That's how the market has developed to now. Other changes, underwriters have less bandwidth to meet demand. I mentioned that Euclid had 9,000 submissions in a year. They don't have enough underwriters to handle that many. I would say probably 10% of those deals were denied at the point of receipt just because they couldn't handle it. So getting deals in early is the name of the game. The policies are getting broader, okay, and they're putting fewer exclusions in that I mentioned earlier. They are limiting the reps that are being broadly worded, but that's something we can get into at a later time, okay? And the rep and warranty insurers are now actively looking to other insurance policies out to insulate their policy. So they're going to insist on a client having a cyber liability policy. If it's appropriate, environmental or regulatory liability, they are looking for umbrella policy and D&O EPL tails, because those are areas that will insulate a rep and warranty policy. People ask about COVID. All you need to know right now, it's still a little bit early since COVID. So there was a slowdown in transactions. So the policies that had no COVID limitations, haven't really come in with claims yet that we can see. Underwriters are getting a lot more reasonable about COVID-related issues. A lot of things that they're more worried about are the PPP loans and other financial loans that were coming out that may be, very complicated, and they may be breach of those. So that's about it. Okay. There's greater scrutiny now on environmental, social, and governance issues. If you're going to put out there that you are an ESG company, be ready to get second guessed a lot. And these claims can get big down the road, because there's, social inflation, and there are a lot of people out there that will really want to stick it to a company that claims that they're environmentally friendly when they really aren't. We were expecting a lot of distressed M&A, and it just didn't happen thanks to the government stepping in and really bailing out a lot of companies. So we didn't see that many types of deals. Okay. And then as private equity firms are maturing, they have some of their funds where they still hold some companies, and they put them off into runoff in another fund. So that's what we call the secondaries market. So that's a development that we haven't seen before. Let's talk about claims, because this is why private equity loves this, because this is an argument that I had with attorneys in the early days is, what's better than having cold hard cash sitting in an escrow account? Okay, this insurance policy isn't going to pay, and then we're going to have to sue the insurance company for bad faith. Why do that? Okay. Rep and warranty policies, boy, they deliver like nothing else. I'm very, very proud of this as an insurance broker, particularly a D&O broker. Okay. First of all, how many claims? Well, these policies, about 20% of them are going to report a breach of some type. That doesn't mean it results in a big claim or a claim that exceeds the deductible, but 20% of the policies report a breach. Okay. Of those who report the breach, And about 40% of these claims lately are reported within 6 months of the closing date. So they're reported very quickly, okay? But 75% of these claims are paid and closed within 12 months. You don't get that kind of turnaround, I can tell you. Of the people, the policyholders that were surveyed, 88% were somewhat to highly satisfied with the process, okay? And having a broker that knows the parties, understands this, is a way to really facilitate communication and get these things happening a lot faster. And again, as a D&O broker, policyholders get reluctant when the claims people start asking questions, because there's a belief that, hey, you know what, you guys are trying to chisel out of a claim, and I'm reluctant to answer your questions. Not the case with reps and warranties. Okay, again, impact COVID has been modest. The most common types of rep and warranty claims, anything dealing with the financials. If there's a tax issue, it's usually because the target company gets sold, okay, and then about 6 months later, they get audited by the IRS, and immediately, boom, that triggers a breach. And so the audit may not result in anything, but that happens. The other issues now that's coming up are material contracts with customers and suppliers. Those tend to be the things that are out there going on right now. And then we have a rise in fraud allegations. If you've got a rep and warranty policy that you went cheap and you only bought a $5 million policy and you have a $9 million loss, expect the buyer to claim fraud against the seller. So beyond the claim, it's just a trend that's out there to be aware of. But here's the big thing. Okay, rep and warranty policies are very, very profitable. Okay, and private equity and the M&A community is very small. The insurance policyholders have huge leverage over the insurance companies, because, hey, if there's a claim that falls in the gray area and you have repeat buyers that are consistently buying these policies, the last thing you want to do is have a reputation within the M&A community that insurance company XYZ, they're reluctant to pay a claim. I guarantee you nobody will come to them at no price. So that kind of leverage that the buyers have over the insurance company is unmatched in any other line of insurance. Well, let's talk about the biggest benefit that comes with rep and warranty. And this comes from me having conversations with literally hundreds of M&A professionals out there. And again, I told you that, private equity was a reluctant purchaser of rep and warranty, and they are the biggest fans of it. Okay. Why is that? And this is the emotional thing. Okay. You eliminate contentious negotiations in the deals. And that has all the difference in the world. Remember something, and again, this is stepping back, just a little global perspective of M&A. This is not company A, Amazon buying Walmart. Okay, this is a group of people choosing to partner with another group of people. So this is all people involved, okay? And so you've got dynamics that you need to appreciate with that. And so when you can avoid chance of contentiousness, it's key, okay? And it happens just in the nature of the deal. A lot of companies that are the private equity firms, they're buying, hundreds of companies over a 10-year span. They're doing this all the time. It's like, somebody that's selling a home. Okay, realtor knows how to do these things. The target companies, the sellers, the owners, founders, they've probably built a company over 10 or 30 years. They haven't sold their business, so they don't know what's happening. And so it's nothing, mischievous or adversarial. It's just you've got an experienced party on one side that is used to these things, and the inexperienced people that get defensive. And if they don't get defensive, maybe their attorney gets defensive because their attorney representing the seller doesn't really know exactly what is common, or what we call market, in negotiating M&A terms. Okay, and so this is where this comes in. It comes in the indemnification section. Okay, where I mentioned that's a money back guarantee that the buyer gets at the expense of the seller. Okay, and so what happens is the inexperienced sellers, they put their, they meet the buyer, and the buyer says, we're going to perform this due diligence process. It's real straightforward. We just need to check some stuff. And they are dragging every document, every possible thing out of the seller. And the seller is just, after this process, because they're not used to it, they're exhausted. And so they go ahead and they shared everything they had with the buyer. And then they go to this negotiating the final parts of the deal. And then this, this topic comes up, indemnification. And then the seller's like, what the buyer says to the seller is, okay, look, we're making a big investment. We believe in you, and we don't anticipate any problems, but just in case, you'll have to understand, we have to kind of hedge our bets and hedge our risk a little bit. So should anything happen that's really big, and we don't think it'll happen, but just in case it does, we have the right to claw back X amount of your money. Okay. And that's just what the buyers are going to tell them. And this is usual, is common. We don't think it'll happen, but we kind of have to do this. So what the seller hears on this, and they're inexperienced, they're like, the buyers just said, wait, I know we just went through this real invasive, exhausting exercise of due diligence, but just in case we miss something, you're still going to be responsible. And all of a sudden the sellers get defensive, and the sellers will say, wait a minute, you can't blame me for something I didn't tell you, that I didn't know. I told you everything I know. And the experienced buyer says, well, yeah, I realize that. But I'm betting tens or hundreds of millions of dollars that your memory is perfect. So you can see how all of a sudden you got that contentiousness. That gets eliminated with rep and warranty, because now all of a sudden, you get that if there's this indemnity cap and there's the escrow, well, there's no escrow now. And if something bad happens to the seller, we're not going to come and wring it out of you. We're going to go ahead and get it from the insurance companies. We'll get this taken care of. And I can tell you, in the tech sector here, particularly on smaller deals, a tech company will buy a smaller target, okay, and it's largely to bring the engineers and the personnel over. It's what we call acqui-hire. And they give them a bunch of incentives, and they say, well, we've got this escrow here. There's a real dilemma if there is a breach post-closing, because now you brought that management team from the target company into your home. And now they're in, and they're participating, and they're rock stars and doing great. But they're looking to, okay, I can't wait till we get our escrow payment back, because I'm really looking forward to that. And then you have the dilemma where, do we tell them that they just lost their escrow, or do we just suck it up and pay them? A lot of times, a lot of tech companies, to protect their rock stars and ensure that those guys stay, they eat the loss, okay, because it was uninsured. You have a rep and warranty policy, now you don't care. You've got that. So it's a wonderful, wonderful stuff for that. Again, I want to just bring you back to this. We could set this transaction price at whatever. We can set the indemnity cap up, down, however it wants to go. And this can all put together. But I think when you do a side-by-side to the deal parties, okay, and you show, they'll look and they'll say, oh, it's $315,000. That's a lot. It's less than 1%, okay? And for the wear and tear on your soul that you can avoid, again, the attorneys and the people, when we show them the side-by-side, they always say that's a no-brainer. And that's what we have. And if you'd like, I would say, if you have a deal out there, we could put a table like that together for you. And these deals go in a number of different sizes and shapes and whatever. So happy to do it. And so if you want for us to take a look at that for you, again, it's complimentary. Here's my contact information. I'm also, for those of you in the Liberty community, it's the same as a Liberty address. It's pstroth@libertycompany.com. And then also my number is there for you as well. So Tanya, you can take it from here.
Thank you. Wow, Patrick, I feel like you just went over 2 hours of information in 40 minutes.
Was that exhausting? Rich. I'm sorry.
No, it was fantastic. You went through everything so fast. I feel like you were able to get through so much content in a short period of time, and it was all so informative and rich. So thank you. We do have a few questions here in the Q&A. So here's a question from one of our attendees, Patrick. Have you seen any P&E firms explore captive to help retain some of the leakage in their transactions, given the rising rates and strain on capacity for R&W?
That would I haven't seen that. However, I'm working a lot of my practices on the deals that are $500 million transaction value and down, where you're going to see the need for captives, or where you've got the billion-dollar deals, and they've got multiple billion-dollar deals, and they want to get, $300, $400, $500 million in limits, and they may only be able to get, $250, $300 million in limits. And that's a capacity issue is happening because the deals are getting bigger. In the old days, I mean, there weren't as many billion-dollar deals 5 years ago, but not only were there not as many, but those big deals, they wouldn't get insurance. They're too big. We'll self-insure. Now they're all getting in that. So we haven't. I can't comment on the captives.
Okay, Thank you. Another question we have here is how big or small of a deal is subject to insurance?
Where we see the ballpark is, I mean, we can do deals as low as $20 million in enterprise value. I go by enterprise value. A lot of times they say EBITDA and they get into multiples, but I look at that. The challenge is, I mean, we can look at deals at 20 million in enterprise value all the way up to 500 million. If you got something bigger, of course we'd look at it, but our bandwidth right now is going to be, the sub $300 million deals. The issue with smaller companies, you have to have a buyer that's doing the due diligence. And that means they're getting financial diligence reports, legal diligence reports, other reports like that. And sometimes buyers don't want to spend that amount of money, even if the seller will pay for it. It's just too tedious and it's too small of a risk. But with that, I can segue into, there's another product out there for smaller deals that are 20 million and down. But the threshold, probably 25 million is your safe zone and up.
Okay, good to know. So also, what type of information do you need for submission?
Sure. What I'd like, and a lot of these things are all subject to non-disclosure and things like that, which we understand completely. So what I need to know is what type of company, what industry is it in, where is it located, what is the purchase price, and then what is the amount of insurance needed. So if you've got a $100 million deal, do they want a $10 million policy? Do they want a $20 million? Let us know that. And then finally, what's your scheduled close date? Because if somebody says, well, we're coming out 6 months from now, great, we can do that. But if somebody says, well, we need this in 2 weeks, that could be a problem. But though we just need that information, we go from there.
Awesome. That's all really good to know. Some great questions from our audience here. And our last question is, are there any types of deals that cannot be insured, and what classes of business do you prefer?
I could tell you that we haven't seen a business that can't be subject to insurance. It's really dependent on, is this a burning fire that can't be covered, in advance? So industry, I mean, we were just talking to a private equity firm looking to purchase a number of pawn shops. So we can do pawn shops, casinos. We see a lot of, obviously, technology. Manufacturing is a highly desired class of business. Business services, logistics, you name it, they can do it. Where you're going to have issues or concerns, and the rates will be higher, are going to be firms that are in highly regulated industries. So that's the financial sector, banks and so forth, as well as healthcare. Okay, we can chop and slice and dice healthcare a little bit. We can refine that a little bit. I'm more familiar with that universe, and there are different segments that are available. According to a recent report, one of the insurance carriers said 50% of their claims are coming from healthcare and IT companies. So, and everybody wants to do IT at some level. Healthcare is a little bit strange, but the popular term a lot of firms use is the carriers are agnostic. But we know which markets like which risks.
Mm-hmm. Okay, great. And actually, one more question here. Are you available for a call with an M&A lawyer to go over the program? Anytime.
I do that. I'm happy to do that routinely. Absolutely. Yes. And you've got my contact information. Reach out, ping me. I'll send you a Calendly link. Happy to talk. Okay. Well, thank you so much, Patrick. That is all of our questions for today. And to our audience, if you enjoyed today, we actually have a upcoming webinar in 2 weeks. Patrick, do you want to talk a little bit more about that? Yeah. So I mentioned that, Euclid Transactional, their average deal is 500 million now. Okay. And they had 9,000 submissions last year. Okay. That's for deals that are north of $50 million is usually where Euclid starts looking. Okay. They had 9,000. Well, there's 10 times that many deals happening a year in what we call the micro market. Those are transactions where you've got company values from as little as $1 million all the way up to $15 million. We can look at 20 million as well, but that's a new segment that's out there where we have really bailed out the true entrepreneurs that, they don't qualify for the rep and warranty. So what do? They out scout? No, we've got a product that's designed for them. There's only one market that does this. So I'll tell you, if you want to have a real presence with a lot of your commercial clients that would fit into this, this is the area to go look at. And it's called TLPE, which stands for Transaction Liability Private Enterprise, and it is a groundbreaking program out there. And we have seriously just changed some entrepreneurs' lives with this. I am very, very proud of that product.
Thank you. Yeah, we're very excited for that webinar coming up. And just to our attendees, please note that all registrants will receive the recording of the webinar today, as well as the registration link to this TLPE webinar that's in a couple weeks that Patrick just discussed. So you'll be receiving all that information in the next couple of days. Well, if there's anything else, Patrick, I think we should wrap up. But thank you all so much for your time and for joining Patrick and I today.
Yeah, and the only other thing I'd throw out there is reach out to me. We have content pieces, we have brochures, we have a whole bunch of content that we'd be happy to share with you to help explain this in layman's terms to prospective clients or centers of influence. I would say M&A attorneys are profoundly useful for us, because if an insurance person is talking to a prospective client listens to it politely, but there's a filter they have. It's an insurance guy talking. When their trusted advisor, an M&A attorney, discusses this with them, all of a sudden it puts this at a much higher credible level. We really love working with our attorney partners out there.
Absolutely. Well, thank you again, Patrick, for all of your time today and going through all this extremely helpful information. I'm sure our attendees are also grateful. So thank you all for your time, and we will hopefully see you all soon.
Take care. Thank you again.
Thank you.